This is Horizon's Middle East and Africa. Our top stories this morning. Asian stocks fully recover from last week's rout as traders shift their focus to key US inflation data for clues on the Fed outlook. The US warns against an Iranian attack against Israel is increasingly likely as efforts to revive Gaza ceasefire talks intensify. And in today's Big Take, how Western asset managers are being asked to do more to win a slice of $4 trillion in Gulf sovereign wealth. It's just gone 8 a.m. across the Emirates. I'm Lizzie Burden in Dubai, in for Jemana Basecci. Welcome to Tuesday. It's been a little bit of a different week, shall we say, to last week so far. You've got equities getting back on their feet after last week's market meltdown. And you've got futures here pointing slightly higher in both Europe and the US. We're awaiting that CPI print, of course, from the US tomorrow. But then later on, we'll have NVIDIA's results and Jackson Hole beyond that as potential further catalysts. So it's feeling a little more like a more usual August. But what has been moving markets is this angst that you're going to see a retaliation from Iran against Israel at any moment. And therefore, we've had Brent back above $80 a barrel, the US 10-year yield at 3.9%, but pretty steady as things stand. But as we await that CPI print, we've actually got even more data out of the US today, PPI. So if we flip over for a bit of a preview for this number, the expectation is that it's going to be pretty much the same as in the previous data for the core and headline levels for PPI. What's important here, though, is the components that feed into core PCE, the deflator, which comes out on August the 30th. That, of course, is the Fed's preferred inflation measure. Our economists say that these numbers probably won't give the Fed much comfort about starting easing, but it won't get that data until the August jobs and inflation data. Still, we'll bring you the PPI numbers when they drop at 4:30 p.m. Dubai time. Now let's get to Asia. Avril Hong's on standby for us in Singapore with the latest on markets there. What's happening where you are, Avril?
Yeah, Lizzie, we're seeing Japanese markets back from a holiday and playing catch-up to the extension of the rebound we already saw in parts of the region a day ago. And we're seeing the weakness in the Japanese currency helping some of the export-related stocks. But note here that even though we see the rebound in Japanese equities, some gains in tech, and some of this is also earnings-related, the Kospi, the TAIEX, they flip into negative territory, erasing gains from earlier on in the session. So this tells you how frail sentiment really is and the risk going forward if we get the US inflation print reinforcing those concerns about a hard landing scenario. The other sector of the market I just wanted to flag to you is what we're seeing in CGBs. We saw a lot of selling in Chinese government bonds a day ago amid measures to cool the rally, a bit of an unwinding of that today, but we're seeing essentially the authorities there taking more extreme steps to cool that rally. Lizzie.
All right, thanks for the update, Avril Hong in Singapore. But let's continue to talk about CPI and the broader markets with Britney Lam, head of Equities Long and Short at Magellan Capital. It's your first appearance on Bloomberg TV. Welcome to the programme. We're looking at this CPI data, but all the US data this week. Is the market pricing for rate cuts from the Fed too aggressive currently?
Yeah, nice to have me, Lizzie. Thank you so much. I think the market is really expecting a 3% print, which is pretty much flat to slightly lower, which is a drastic change compared to what we're pricing in now is 4 cuts into end of this year, which is drastic change from what happened before that bout of volatility last week. So I think it is quite a change in terms of expectations. But personally, from where I sit, I think the key thing is actually not how much or even when the rate cut happens. I think markets price that in. It's actually the business sentiment. So let me give you an example. A key thing that I'm looking out for in terms of macro data is actually the NFIB survey, which actually supports or points to business confidence in the U.S. So I think that print is something that I would highlight to look out for, because right now, currently, the market is actually still pricing in a 75% probability of a soft landing. Yeah. So I do believe that's quite complacent, because one data point that sets off a little bit of alarm bells for me is actually the U.S. prime rate, which is where the small, medium businesses borrow at, which is not sitting only at a decade high, it's actually a century high. So I do believe that rates need to be cut and we need to be careful about growth.
It's really interesting. So looking beyond that headline point to some of the other data points that you're watching. So you agree that the Fed is going to cut, though. There is, of course, the possibility that if the cuts come, when they come, more carry trades unwind, as we saw last week, and that instead of saving the market, actually you get more turbulence. How concerned are you about that?
I think there was a great unwind of that volatility trade. So basically what people were doing is that they herded in towards short volatility, short the yen, and then long Japan equities. So that's where that great unwind happened, and it sort of spewed over to everywhere that was funded by this trade. I do believe that there are much smarter people on the street than I am that have basically said, it's 75% unwound. I do believe a lot of that has been done. So I think it's cleaner now in terms of positioning and what we can expect. So we dial back down into looking at really the fundamentals. Everyone will be watching like a hawk on the macro data, because it would point to further future growth, whether we're heading into a soft landing or there's more that needs to be priced in.
So to be clear, was last Monday's meltdown just a blip or a harbinger of worse to come potentially? Is this volatility maybe the new normal?
I do believe because of the way markets have sophisticated in terms of how we invest, it becomes quite herded. So there is a lot of crowded trades. Once it unwinds, is something new. So, for example, the next black swan event could actually be the war, sadly, that is potentially going to happen. And I don't think anyone is really prepared for that. So I do believe that there could be other potential black swans that we need to watch out for than just that volatility alone.
Yeah, well, I mean, we do keep an eye on that geopolitical risk. I mean, we've had Mike Wilson over at Morgan Stanley saying that this double whammy of the economic uncertainty and the weak period of corporate earnings forecasts actually are going to cap stock market gains. In your view, do you think that the fundamentals have deteriorated enough to warrant de-risking?
I do believe we need to be concerned, so especially in places such as AI, where you have everyone's drunken from the AI punch bowl, I call it. So imagine if we're on a Friday night out, we're definitely past midnight. So
time for the Uber.
Exactly. So don't leave yet. I'm not saying to pack up and leave, but just be cautious, because the way I look at especially tech stocks is what drives it is actually the peaking out of the top line sales growth momentum. So it's important not just to look at the fundamental earnings growth, but for tech in particular, it's actually the top line growth. So imagine you're riding a roller coaster. So even if you continue to positive growth, it's the peaking out of that number that really drives the momentum for that stock.
Exactly. So the bigger question is how much room more does the bull market have to run?
So under that same house as Mike Wilson, Sean Kim also mentioned that maybe another 2 to 3 quarters, which I sort of believe as well, according to my own numbers and the companies I talk to in tech.
Okay, really interesting. Just finally, where are you looking for the opportunities in Asia?
So I find Asia still very interesting on my own part because of where I come from in Hong Kong.
Just moved over, right?
Exactly. So I do believe that there is still potential and opportunities. As a shareholder in equities, you're really looking for return on equity. So, for example, I think China has structural issues that are very difficult in the near term. So you have deflationary pressure, you still have GDP growth slowing, which weighs on consumption and investment growth. So a little bit harder. I think earnings cuts will continue despite already 8 quarters for China. But places such as India and Japan, I think there's more structural ROE growth that can be good opportunities to look at. But lastly, let me point out in tech, which is near and dear to my heart because I do market neutral, so I do find pairs within the subsectors. I do find analog and power semis to be quite interesting at this point of the cycle. I call it sort of like a last in, last out. So kind of the opposite of AI, where I do think valuation is more attractive. You have inventory that's cleaner, so you have potential restocking demand to drive share prices.
Okay, really interesting. Britney Lam, head of Equities Long and Short at Magellan Capital. Lovely to have you with me on the programme. Thank you. Now, I mentioned the US data that's coming out this week, but it's not the only data we're looking out for. We also have plenty of data out of the UK, which, of course, is going to be crucial to when the Bank of England cuts rates again. This morning, we'll get the latest pay and jobs numbers. Tomorrow, it's CPI. On Thursday, it's GDP. And on Friday, retail sales. Now, what's really interesting is that UK inflation is expected to pick up for the first time this year. here, which surely will only add caution to the Threadneedle Street bandwagon. Remember, this month's rate cut was already on a knife edge, a 5-4 split. And even before tomorrow's data, the MPC's arch hawk, Catherine Mann, said in an interview with the Financial Times that we shouldn't be seduced by headline inflation falling to the 2% target, that actually she's concerned about the labour market. Now, at the same time, as we could see later this morning, unemployment's expected to rise by the most since 2021. So that poses fresh risk to the recovery from last year's recession. That adds to the doves argument to keep cutting. Now, broadly, before this data, economists' view is that you're going to see a hold in September and a cut again in November. But where does it leave markets? We'll take a look at this chart in front of you. The pound is still the best performing G10 currency this year. It's struggled for momentum recently. You've got softer than expected growth data maybe coming this week. That could make sterling vulnerable to another leg lower. But traders expect less easing from the BOE than the ECB and the Fed. And as you can see right here in this chart, the BOE actually has the tightest real policy rate of the major three Western central banks. And actually, it's the RBA that has the loosest. So we'll keep an eye on all of that UK data out this week. But still ahead, right here on Horizons, Elon Musk is pitching himself for a role in a potential second Trump administration. He's been hosting the Republican nominee on X. We'll bring you the details shortly. But first, the US believes an Iranian attack against Israel could come as soon as this week. We're going to bring you more on those rising geopolitical tensions here in the Middle East next. This is Bloomberg. Welcome back to Horizons Middle East and Africa. I'm Lizzie Burden in Dubai. Now, the US believes an Iranian attack against Israel may come as soon as this week as the Pentagon deploys more forces to the region. Joining me now is Bloomberg's Honor Ant with more details. Honor, markets are bracing for Iran to retaliate against Israel. The US and Israel say it's increasingly likely. I suppose the question at this point is, why hasn't it happened yet?
Well, that's a good question, and a question the answer to which no one really knows, except for the fact that probably element of surprise is the only leverage, or one of the few that Iran has on its side in terms of the timing of the operation after its well-telegraphed attack on Israel back in April. Failed to do much from a military perspective, really, despite the fact that Iran has been telling its internal audience that it's been a success. So that's one fact that we have. On the other hand, though, yesterday was the first time that White House said both the U.S. and Israel believe that an attack that Iran has been saying that it's going to conduct against Israel is now increasingly likely. We have seen the implications of that already. The U.S. movement of military assets into the region, but yeah. More and more, the messages coming out of Washington as well as other capitals in Europe, including Italy, actually yesterday, it's very obvious that everyone sees now an attack by Iran is almost inevitable, and that seems to be what the Iranian acting foreign minister told his Italian counterpart as well, according to the latest reports that we have from Italy.
And so, where does it leave the proposals for Gaza truce talks that were meant to happen on Thursday?
Well, the talks are still scheduled to take place on Thursday, and Iran has made it very clear repeatedly that whatever it does to Israel or against Israel should not put in jeopardy those talks. But whether or not that's going to be the case, I think that's really outside the control of Iran once an attack really does begin. But the expectation, at least initially, was that Iran could delay its response until those talks are scheduled to take place later this week, which, as you said, is going to be on Thursday in Doha, the Qatari capital, which is where the Hamas bureau is.
OK, and you mentioned some of the preparations that Israel and the US are making for a potential Iran retaliation. There are also concerns about trade through the Strait of Hormuz. Just talk us through some of those concerns and what preparations are being made.
Well, as I said, the main concern for the global community in the event of a wider war is obviously what happens to global trade, given the fact that Hormuz, which is between Iran on the one hand and Arab countries on the other hand, is one waterway that over 1/3 of the world's seaborne crude oil goes through every day. What happened over the last 2 weeks, which is something that we knew already in great detail, is that the U.S. was already moving past to the region. What happened yesterday overnight is that for the first time they said they're expediting the arrival of their military assets. That includes a USS, an aircraft carrier, USS Abraham Lincoln, as well as a nuclear-powered submarine that has the ability to carry up to 150 Tomahawk missiles. These are very important details because Tomahawks in the past have been used for ground operations or targets on the ground in the region. And that says something about the preparation in place by Israel and its allies, including the US, in terms of how they intend to intercept incoming Iranian attacks when there is one, and B, what happens next.
Bloomberg's Honor Ant, we thank you so much for the latest on the situation here in the Middle East. And of course, we continue to think about the potential human cost, already. There's also the financial cost of the war. And we have seen Israel's sovereign debt cut by one notch by Fitch ratings as the war in Gaza weighs on public finances. Fitch lowered Israel's score from A to A+, citing geopolitical risk. And Fitch analysts see the conflict in Gaza lasting into 2025, with a chance of it broadening on other fronts. Of course, Moody's ratings gave Israel its first ever sovereign downgrade in February, cutting it one notch to A2 with a negative outlook. We also have the news that the US Secretary of State Antony Blinken is scheduled to travel to the Middle East tonight. This is according to an Axios reporter in an ex-post citing an unidentified source. But let's focus on the domestic US politics now. We've had Elon Musk hosting a conversation with the Republican presidential nominee Donald Trump on Musk's social network X. And during the discussion, Musk pitched himself for a role cutting federal spending in a second Trump administration.
I think it would be great to just have a government efficiency commission that takes a look at these things and just ensures that the taxpayer money, the taxpayers' hard-earned money, is spent in a good way. And I'd be happy to help out on such a commission.
I'd love it
if it were formed.
Well, you're the greatest cutter.
Well, for analysis of that conversation, Bill Ferries, our Asia senior editor, joins us now. Bill, Musk's just given Trump a massive donation. He's kind of playing kingmaker here. I wonder who you thought gained the most from this conversation on X Spaces.
Well, it was a rough start for this conversation between the two. It was delayed by almost 40 minutes as there were some technical glitches. Musk's team has said that there was some kind of a cyber attack. We've seen this kind of issue before on Twitter, or X as it's known, and previous events where large numbers of people sign up. It looked like the conversation peaked at 1.3 million. But the rough start for Musk. But, in terms of Trump, he has such a smaller audience on his own network, Truth Social, that he is, in some ways, he probably benefited more just being able to reach out to some of those people who continue to be on X and who he had a large number of supporters there. He had a large number of followers back when he was president, before he was temporarily banned in early January 2021. So it might have been a better showing for him, but it was a kind of a rambling conversation, typical of a lot of Trump rallies. So I'm not sure if he won over any new converts, but some of his core supporters were probably glad to see him.
And you've got many commenting that those technical glitches don't exactly reflect well on Musk's competence when he's pitching himself for a job in the second Trump administration, if it happens. What sort of role could we see?
Well, Musk was really focused on some kind of the government spending commission that would look at how, where government money is going. I think a lot of people in Washington might kind of roll their eyes at that idea, but it is worth remembering that Musk was on a CEO commission very early in Trump's term back in 2017. He and several other high-profile CEOs ended up quitting that commission over frustration over things like Trump pulling out of the Paris climate change agreement and other events. And Trump eventually kind of disbanded that whole group as more and more CEOs looked for the exit. They had a very acrimonious relationship 4 or 5 years ago. They've obviously patched that up. Musk sees it in his interest to be backing Trump now, so they've probably gotten over that. But it was kind of a wide-ranging 2-hour discussion that kind of hit on everything you can imagine.
All right. Well, Musk's influence in Washington clearly growing. Bill Ferry's our Asia senior editor in Singapore. We thank you for the analysis. Now, we've discussed one of the major wars happening in the world. Let's look at some of the other stories we're following, because sources say that Russia and Ukraine intend to keep pipeline gas flowing to Europe despite fighting near a transit point for the fuel. It comes as Ukrainian President Volodymyr Zelensky publicly confirmed for the first time that his forces have seized a swathe of Russian territory. He says the operation is being conducted to protect Ukraine's border region. Meanwhile, Putin has cut off an acting regional governor during a televised meeting when he suggested that Ukraine's military had taken control of 28 towns and villages in Russia's Kursk border region. Well, coming up on Horizons, Wall Street firms are being urged to have more gatherings in the Gulf as Middle East sovereign wealth funds flex their financial might. We're live in Riyadh next. This is Bloomberg. Welcome back to Horizons Middle East and Africa. I'm Lizzie Burden in Dubai. Let's get to some of the other top corporate stories we're following this morning. BHP Group is ramping up efforts to avoid a strike at the world's biggest copper mine. The company says it presented a new wage offer to union leaders in Chile, which includes a nearly $30,000 signing bonus and improved benefits. Failure to get the union's approval would set up a stoppage at BHP's Escondida mine, which accounts for about 5% of all the world's mined copper. Well, coming up, we're going to discuss oil and OPEC with Carla Slim from Standard Chartered. That's next. This is Bloomberg. This is Horizons Middle East and Africa. Our top stories this morning. Asian stocks fully recover from last week's rout as traders shift their focus to key US inflation data for next clues on the Fed outlook. The US warns again an Iran attack against Israel is increasingly likely as efforts to revive Gaza ceasefire talks intensify. And in today's Big Take, how Western asset managers are being asked to do more to win a slice of $4 trillion in Gulf sovereign wealth. It's just gone 8:30 a.m. across the Emirates. I'm Lizzie Burden in Dubai. A very good morning. Welcome to Tuesday. It's feeling a lot more like August, isn't it? We're seeing equities recovering somewhat from last week's rout, and we've got futures pointing higher on both sides of the pond. European futures pointing to a 0.23% higher opening, a 0.1% higher stateside, but really the action has been happening in oil, back above $80 a barrel for Brent. This partly on the geopolitical risk. We do await potentially a retaliation from Iran against Israel, but it's also about the demand story. We've had the OPEC report, we await the IEA report, and we'll get into all of that in a moment with Carla Slim. But just also a look to the US 10-year yield. 3.9% is where we stand currently, so not a lot of movement currently there. But if we flip over, we have various catalysts potentially coming up. We've got US CPI. After that, we've got Jackson Hole, we've got Nvidia's results, but today we'll have US PPI. So let me take you to a little bit of a preview. It's expected to come in at a similar pace to June at the core and headline levels, or even slightly softer. But really what's important here are the components that feed into the Fed's preferred inflation measure, the core PCE deflator, and that comes out on August the 30th. Now, our economists say that these numbers probably aren't going to give the Fed much comfort about starting easing. It's not going to get that until after the August jobs and inflation data. But we will bring you these PPI numbers at 4:30 p.m. Dubai time. Now, let's check in on how Asia markets are faring. Avril Hong is on standby for us in Singapore. Avril, what's happening where you are?
Yeah, Lizzie, we're seeing Japanese stocks leading the way in this part of the world. And this is a catch-up of the previous session where we saw many of these major indices finish in the green, but they flipped now. The other correlation I also wanted to actually highlight, apart from what we're seeing on the weakness in the yen supporting some of the export-related stocks, is what we're seeing in the JGBs. Our colleague Sunao Imada wrote a really good piece on the MLive blog, and it shows you that based on the recent sessions, Japanese equities tended to rise along with higher yields. And this sounds a bit counterintuitive because higher yields tend to mean higher borrowing costs, not great for stocks. But in this case, it denotes that risk appetite is coming back and traders are selling bonds. So another dynamic to watch as we keep an eye on Japanese stocks. Lizzie.
All right, Avril Hong in Singapore, we thank you for the update from Singapore. But let's come back to the Middle East now, because global investing titans are confronting a shift in the way business is being done with sovereign wealth funds across the Middle East. And this is the subject of today's Bloomberg Big Take. It explores how state-controlled funds in the UAE, Saudi Arabia and Qatar are increasingly asking private equity firms and hedge funds what they're willing to do in return for investments, rather than just handing out checks with no strings attached. Joining us now for more on this Big Take from Riyadh is our Saudi Bureau Chief, Christine Burke. Morning, Christine. I wonder what sort of demands the sovereign wealth funds are making of the hedge fund honchos.
Well, let me first just say that what we are talking about here is a shift in the power dynamics that we are seeing in the relationship between sovereign wealth funds in the Middle East and global asset managers. So it used to be, Lizzie, that asset managers would come to the Middle East, stay at these five-star hotels, be shuffled around a few offices, and then leave with the equivalent of a suitcase full of cash to then go and invest as they wished. Now our reporting indicates that things have changed. We interviewed more than a dozen different sources that have said that asset managers are now being asked to agree to certain conditions in exchange for investments, conditions like agreeing to set up offices here in the Middle East and to host events that raise the profile of the region. Essentially, it's as if the sovereign wealth funds are flexing a bit. They're demanding more in return for their money. They want to see commitment to the Middle East. They want a bigger share of profits. And so it just looks like what's happening is this relationship between the two is becoming more of a co-investment, a partnership. Ken Kaleha, an advisor with Rothschild, summed it up quite nicely. He said, it's not just about financial returns anymore, but what the investments will bring back to the region.
OK, it's really interesting reporting. I mean, the question for me is why now? Why are they flexing their muscles at this point?
I think the simple answer, Lizzie, is because they can. I mean, we're talking about sovereign wealth funds that are sitting on almost $4 trillion worth of assets, and that's expected to grow to more than $7.5 trillion by 2030. So these sovereign wealth funds, they know that the world is out for this cash, and they know the importance of this cash to Western capital markets. Perhaps the deeper answer, though, is that these sovereign wealth funds are key drivers of the economic diversification that is happening across the Middle East. And so they're just choosing to be a bit more strategic with their investments. It's no longer just about a return on profit, but rather investing their money in places that further their agendas. When you look at Abu Dhabi's Mubadala, for example, it's putting its money in places that further its agenda to become an AI hub. You look at Qatar, the QIA is investing in things that help it to develop its chip industry. So it really goes back to being strategic and furthering the agenda of economic diversification.
So that's what the sovereign wealth funds want. What's the reaction on Wall Street? Do you think that financial institutions are going to be willing to play by these new rules?
Well, that's probably the most important question, Lizzie. And early indications are that Wall Street is actually playing a bit of ball under these new rules. So BlackRock earlier this year, for example, agreed to an investment of as much as $5 billion from Saudi Arabia's public investment fund. And in return, it agreed to set up a new investment firm here in Riyadh that will invest specifically in the Middle East. So deals do look to be going ahead in these new circumstances. I think the risk with that is that we see Wall Street make concessions that ultimately eat into their profits. So we know that some sovereign wealth funds have asked managers to cut their fees, for example, and to change fee structures. And we also know, based on our reporting, that some asset managers have agreed.
All right, Christine Burke, a fantastic big take. I do encourage everybody to take a look at it on the terminal. We thank you for the preview. Now, of course, what's lining the pockets of these sovereign wealth funds is often oil, and we can go to oil now. OPEC has trimmed forecasts for global oil demand this year and next as well, as it prepares to decide on a planned supply increase. The cartel still sees consumption expanding by a healthy 2.1 million barrels a day in 2024. That's far above industry consensus. Joining us now is Carla Slim, Standard Chartered MENA Economist. And Carla, I want to start on the demand outlook. We can get to the geopolitics. Do you think these estimates from OPEC for oil demand are still too confident?
Good morning, Lizzie, and welcome back to the region.
Thank you.
Obviously, there are two big factors that we're looking out for when it comes to the Middle East outlook. One is oil, and these demand forecasts are very important. And the other one is the Fed. That's really the two global inputs that are going to matter for the Middle East going forward. On the oil demand front, obviously, the market is watching very closely to these demand forecasts, whether it's by OPEC or other organizations, to try to determine just how much oil prices and oil markets are being driven by these macro concerns, especially after what we've seen last week in the markets, where it does seem that whatever oil prices do from here reflects very strongly on global growth concerns or a re-rating of global growth.
Well, in terms of the Fed, is there a particular data point that you're watching in this slew of data we get out of the US this week when it comes to oil?
Obviously, US inflation is very important, and that's probably going to cement any market pricing in terms of what we're expecting by way of cuts until the end of the year and then further into next year. We've recently revised our in-house Fed forecasts to factor in 3 Fed cuts in lieu of 2 Fed cuts, what we had in terms of prior forecasts. So this bodes well for us in the Middle East in terms of further easing, given that the GCC mirrors the Fed quite closely. And also when we look at other economies in the region, whether it's Egypt or Pakistan, Turkey, or more easier Fed is a better prospect for our markets.
So how do you factor in the geopolitics? You've had Brent back above $80 a barrel, but then a bit of a retreat. How big of a factor is that compared to the demand story, the macro picture?
It has not been as much as of a factor so far. And I think the key reason why is that the market still isn't very convinced that there's risks to the physical supply of oil, particularly around the Strait of Hormuz. This is something that you were discussing earlier on the show. Yes, it's correct that there's about 20% of global oil trade that flows from the Strait of Hormuz, but a lot of our own Middle Eastern supply in terms of hydrocarbons comes from Qatar through the Strait of Hormuz. And it's really unlikely that we see any attacks on Qatar LNG tankers coming from Iran or these tankers being blocked for any specific geopolitical reason. I think that's why the market has not really priced in a lot of geopolitical risk premium so far in this conflict.
OK, that's really interesting. Of course, one of the economies particularly exposed to lower for longer oil production is Saudi Arabia. Where does that leave ambitions for the kingdom's economic transformations? We were talking about the tourism on the programme yesterday.
Absolutely. So definitely oil revenues play a big part in driving the diversification away from oil and funding it. But this is also why Saudi has put a lot of effort in diversifying sources of funding, whether it's through FDI, whether it's through encouraging different financial markets inflows into Saudi by way of, for example, increasing foreign investor appetite and investment into local currency, debt instruments or equities. That's exactly why they've been also diversifying.
Well, I wanted to ask you, do you think that this new investment law in Saudi is actually going to make much of a difference?
I think it's an important reform, whether as a single change it generates a very big difference. I think it's really a compounding effect of all of the reforms we've seen so far since 2015, really since the 2014 oil price shock. It has a compounding effect. Every single reform matters in the totality of all the reform packages that have been delivered so far.
Yeah, because not all of it's going to happen overnight, is it? I also just want to ask you about Egypt, because we've been discussing the market meltdown. And, of course, one of the countries most affected by the unwinding of global carry trades was Egypt. I wonder whether you think that the local currency is set for further drops.
I think we're watching very closely to how the Egyptian pound trades. There are a lot of concerns that we could potentially see more downsides, concerns from the markets. From our perspective, we revised our EGP forecast for year-end back in June to 49. We previously had it at 45. And we see EGP weakening a bit further into the 50s. By next year. And this prices in a bit of outflows as and when we see them, just like we had outflows at the beginning of August. They were contained. They drove EGP a bit weaker, and we expect that to continue given that there is a current account deficit and Egypt remains reliant on external funding to cover that.
All right. Really interesting to talk to you. Carla Slim, a Standard Chartered MENA Economist. Always good to have you on the programme. Thank you. Now, we were discussing the tensions here in the Middle East, and they've been boosting gold, trading currently, as we see here on the screen, at $2,462 an ounce. But the other clean play as a haven asset on the geopolitics has been the Swiss franc. But if we look here, you've got a check of the metals, and the other big story for them is China. Iron ore retreating about 28% this year on the concerns of Chinese demand struggling. Here we've got it fluctuating around that $100 a tonne mark ahead of a tonne of data this week, and that's going to shed light on Chinese steel output. There you've got copper as well, and we've seen it rebounding in the session because of orders from the London Metal Exchange's warehouses suggesting that China's demand slump may have bottomed out. China, of course, accounting for more than half of global copper consumption. So after a surge to 5-year highs, you've had stocks of warranted copper starting to drop, and you can see the price now on the screen there. But we're going to continue to talk about metals next, because we'll have an update from Africa on Congolese copper exports. Copper staying in focus as we get the latest on that spat between Zambia and the DRC that blocked the exports of the base metal. So do stay with us for that conversation. It's coming up next. This is Bloomberg. Welcome back to Horizons Middle East and Africa. I'm Lizzie Burden in Dubai. Let's go to Africa now. Zambia is set to reopen its border with the Democratic Republic of Congo today after a dispute led to an exports blockade over the weekend. This is according to the state broadcaster ZNBC, which also reported that the two governments have signed a communique to allow Zambian products to enter the DRC without restrictions. And for more, we can talk to Ondiro Oganga joining us from Kigali. Ondiro, what led to this blockade?
Lizzie, it has to go back to 2 weeks ago when Congo slapped a one-year ban on imports from Zambia, including beer, soft drinks and lime. And they said this was in order to promote local production and create employment. The only problem is they did not give prior notice to the Zambian counterparts. What then happened is that there were protests in the border town in DRC, and it led to clashes between the protesters and the police. And what happened next is that Zambia decided to close their border. The commerce minister says this was in no way, shape or form retaliation, but rather it was based on safety and security as drivers were being attacked and trucks were being destroyed. And this is not the first rodeo. There have been protests before in this border town in September of 2022, drivers decrying security and also extortion due to deeply rooted corruption along the border. So heading to the dialogue on Monday, both sides understood the magnitude of the decisions that they would make, and they decided to adhere to the rules and regulations stipulated by regional blocs and also the World Trade Organization.
So it ain't the first rodeo. What sort of impact does a spat like this usually have on Ondiro?
Lizzie, when you look at the impact, you have to take into consideration that almost all of Congo's copper passes through the Zambian border before it reaches other ports, for example, the port of Tanzania, Namibia, and Mozambique. And these are queues that stretch up to 30 miles long. A blockade like this further delays that process and leads to a buildup of trucks. This buildup then affects global supply because Congo is one of the world's largest producer of copper, and any delay in supply will definitely be felt in the market and by extension affect copper prices.
All right, Ondiro Oganga joining us from Kigali. We thank you for that update. And we can go to more stories out of Africa now. Kenya is working to bring back some of the tax measures that it was forced to abandon after weeks of deadly protests. The country's new Treasury head says the government will continue to consult with the public before introducing any measures. The tax bill was meant to raise about $2.7 billion in the current fiscal year, but was scrapped after demonstrations left more than 61 people dead and forced President William Ruto to sack his entire cabinet. Now let's turn to southern Africa, where Botswana is planning to reduce spending on new cars and travel for government officials as diamond sales slump. This is according to the finance minister, who expressed concern after the country's budget revenue in first quarter was 28% lower than targeted. Botswana is the world's largest producer of rough diamonds by value, with the revenues making up the bulk of the government's income. Elsewhere, Gold Fields has agreed to buy Canada's Osisko Mining in a deal worth $1.6 billion. The deal hands the South African miner full ownership of the Windfall project in Quebec. Gold Fields has shifted away from its base in South Africa and is developing the Canadian mine to add to operations that also span Africa, Australia and South America. Well, those are some of your top stories out of Africa. We also have a little update from Elon Musk after his conversation on X Spaces with Donald Trump, the Republican nominee, of course. Musk says that he's also happy to host Kamala Harris, the vice president, who's the Democrat nominee for the presidency. So let's see whether we get a lively debate between the ex-CEO and Kamala Harris as well. Do we see him pitching for a job in her administration, you might ask? But coming up on Horizons Middle East and Africa, as investors navigate multiple hurdles, we're going to hear from the CIO of Guggenheim on Fed policy. So that conversation is coming up next. This is Bloomberg.
If you want to go all the way back to pre-COVID, at that time, the Fed was even talking about trying to create, remember, they have a dual mandate, right? So stable employment, stable prices. Pre-COVID, they were spending a lot more time concerning themselves with this divergence, if you will, of different earners and the underemployed, and this dichotomy that existed. I haven't heard a thing from the Fed in the last 2 years about this issue and what some call the K-shaped economy. And it'll be interesting to see if their rhetoric returns to concerning themselves with the underemployed or the under-earning part of the economy.
When the Fed raises interest rates, it's a blunt tool. It impacts everybody, but to your point, because of what pocketbooks look like, it impacts people differently. Now that we are years into this fresh monetary experiment, how does it look?
If I were at the Fed, I would be thinking about the tools that we have in the toolkit differently. I would be utilizing quantitative tightening, and to a great extent, they have. Post-COVID, $12 trillion came into the global economy from central banks everywhere. And right now, we've seen about $5 trillion has been hoovered back out. That still leaves $7 trillion sloshing around in the system globally relative to where we were before COVID. Now, adjusting that for, larger GDP and GDP growth globally, probably we need to see about $3 trillion more come out before we get to an equilibrium of where we were before COVID. I don't think the Fed really appreciates the quantitative tightening tool as much as I do, and I think as much as the markets do. relatively speaking, to their adherence to rates as like almost the only tool. It seems to me it's a very blunt instrument.
Is there a way for the Fed to more surgically target the ability to balance the haves and the have-nots?
I do think rates are important here. I believe rates should be coming down. I believe they should have come down faster. They raised rates 75 basis points after SVB failed. That's unprecedented in Fed policy action ever, to actually continue to raise rates after we've had a crisis or a moment, if you want to call it that. And so as a result, they could take that 75 basis points right off and put us back where we were in March of 2023. I think they should do that.
If we take a big step back here, you were talking about the haves and the have-nots and that widening. How much does that mean the government has to step up in the future?
Well, I think the government's already stepped up a lot. I'd like to see us spend a whole lot less. What we have done is we've moved, and by the way, I think the Fed's moved this way too, into a world of industrial policy and using large sums of money to address and advance various political and or policy causes.
So that was the Guggenheim CIO Anne Walsh speaking to Bloomberg's Sonali Basak on Next Big Take. You can catch the full episode now on the terminal, on Bloomberg.com or on YouTube, whichever you like. But that does it for Horizons Middle East and Africa. I've been Lizzie Burden in Dubai. Stay with us for Daybreak Europe. That's up next with Tom McKenzie. This is Bloomberg.